Hello friends, today I am going to talk about one of the most important topic of financial market, which is being extensively asked in exam like FRM, CFA or Treasury Management courses of IABF, that is fixed income securities. Because fixed income security is a major portfolio of lot of investors, banks and the financial institutions. Fixed income security typically are the assets class whose income is already known at the time of the investment and which remain constant over a period of time till the maturity of that particular investment. Fixed income security can be broadly divided into two parts. If we talk about the security with a feature of their interest, first is the coupon bond security, second is a discounted or the zero coupon bond securities. Here we can say the coupon securities also can be subdivided into the fixed coupon or the floating rate coupon securities. If we take an example of the coupon securities, let's say there is a 10-year bond issued by Government of India maturing in March 2032, that is its maturity year, and the coupon of this bond, let's say, is 7%, and it is semi-annual basis, and the face value of this bond is 10 lakh rupees. It means each bond is carrying the face value of 10 lakh rupees. The cash flow of this particular bond will be, the investor will receive 35,000 on semi-annual basis, that is in that March and September every year, and on maturity he will receive this 10 lakh rupees plus last coupon of 35,000 at March 2032. So this will be this ultimate maturities. Here I am talking about only the simple coupon and the maturity. I am not talking about YTM here. YTM I will discuss later. Now I will give some example of the zero coupon bond or discounted bond. These are typically money market instrument like CP, CDs or treasury bills. Let's say one treasury bill which is having a maturity of 92 days and it is issued at 98 rupees. The on maturity the investor will receive face value, that is 100. So it means today you are investing 92 rupees and after 92 days you are getting 100 rupees. So your income here is in the form of discounted is 2 rupees, which can be said as an interest income also or can be a discount income. So these are the two broad categories of the bonds depending on the interest flows or interest linked to the securities. Now I will talk about something about the pricing of a bond, what factors affect the pricing of a bond. These factors are not the total factor, there are many factors. There can be multiple factors, but few are very common, or we can say the broad factors which affect the pricing of a bond, especially for in case of the secondary market. So the first factor is here the current rate of interest going on the system or economy. Second, who is the issuer of those securities or bond. Third is tenor, what is the tenor of security, or what is the residual tenor in case of a secondary market transaction. Next is the coupon or maybe the discounts, and fifth is the available securities or collateral available with these securities. So these are the 5 major factors that decide the pricing of a bond. Now I will discuss these factors individually to understand how these factors affect the pricing of a bond, what are the reasons and what are the underlying when we invest in the fixed income securities. Let's discuss about the issuer. Who can be issue bonds? The first category will be the governments or the sovereign, like government of India, maybe the US government, UK government, Sweden. This is German. The security issued by the government is also known as sovereign bonds. The next category is quasi sovereign. This kind of a security issued by the local bodies, like in case of India, municipal corporation, state government. These kind of securities issued which is not directly linked to the central government but the local level government. Third category of issuer are the entities which is owned by governments, like in case of typically if we talk about India, then REC, Rural Electrification Corporations, then RFC, or we can say NABARD. So these are the institutions which is owned by government, and they also issue securities for their capital and working capital requirement. The fourth category can be financial institutions like banks, insurance companies, and fifth category is the corporates like Reliance, or maybe some other big corporate, Bharti. They also issued the bonds for their working capital or might be their capital expenditure requirements. If you see the pricings, then pricing of government bond will be tighter because here the risk is less, and for the corporate, if everything remains same, the pricing of the corporate bond will be much cheaper comparing to the governments because of the risk involved. When the government issues bonds, it is assumed that they will repay on the due dates, but as the credit risk get increased, then the pricing also get increased. So this is the relationship between the issuers of the bond, and it is how the pricing has been decided. So higher the risk, higher the price. Now the next factor that affect the pricing of a bond is the collateral or the security is available with that bond. Here we can say the seniority also affect the price of a bond. Seniority in the sense in case of company going for liquidations or maybe some kind of the bankruptcy, then how the company assets will repay their obligations which is linked to their bond issuance. So seniority also affect the pricing of a bond. Typically the bond issued by various mortgage companies, they create the interest in their asset pool for the investors. In case of the default or maybe liquidations, the asset going to be liquidated and the investors will receive their money back according to their seniorities. If it is a senior secured bond, then they will be given the preference over the subordinate investors. So therefore the available securities or collateral that is earmarked for the issuance of the bond also affect the price. If it is not having any underlying securities or any security which is having a mark to that particular issuance, the pricing will be higher. If that security is linked to the issuance of the bond, the pricing will be tighter in the sense the investor will get the less returns or less yield. And here we can say that there is one more element that is involved, that is credit enhancement. If security is issued with credit enhancement facility, like some corporate guarantees given by some other better rated company or maybe better rated entities, the pricing of the bond get also affected issuance because ultimately the issuer has to pay some kind of the charges or some kind of a money to the who is giving them the credit enhancements.